So far, we've been talking about government intervention in general and about price regulations. However, price regulations are not even used that often. Instead, one of the most widely used types of market interventions by governments is taxation. And this video explains very briefly how taxes work. Before going into how taxes work, let's see the two most widely used taxes in a certain market. There are two types of taxes. The first one is measured as a certain percentage of the market value of the good. It adds value in proportion to the existing value, and that's why we call it an ad valorem tax, add value. The second type of tax is also adds to the market price, but in a slightly different way. Rather than adding a proportion of the existing value, it adds a fixed sum or a lump sum to the market price, no matter how low or high the current market price is. And that's why we call it a lump sum or specific tax. So when you show these taxes on a graph, there will be a slight difference in how the graphs look. The supply curve with an ad valorem tax will rise faster than the supply curve, while the supply curve with a specific tax will just be a new supply curve which was parallel to the old one. Let's see an example of the first type, which is the ad valorem tax. So this is the old equilibrium in the market for salt. The equilibrium is given by P star and Q star. Now, what will happen if we impose an ad valorem tax? The ad valorem tax adds a certain proportion of the price to the existing price. In this case, every unit sold on the marketplace by the suppliers is taxed by the government with a certain fixed percentage of the price. And as a result, the new supply curve rises faster than the original supply curve. This is because each point of the old supply curve is not increased by a fixed sum, but is increased by a certain percentage of the old price. Okay, so what happens with equilibrium in this market? Note that the relevant supply curve now is the new one, the one which is produced after taxation. The old supply curve is just used for reference, for benchmarking, and for welfare analysis. So by looking at these 2 points, we can compare what happens to equilibrium prices and quantities once there is taxation. The first thing to note is that taxation makes the good sold in this market more expensive. The new equilibrium price is P1, which is higher than P star, which was the original price without taxation. As a result, taxation makes consumers pay more for the goods and services they consume. The second event happening on this market is equally important. Look at what happens with the new equilibrium quantity, Q1. The new equilibrium quantity is much lower than the original equilibrium quantity, which was Q star. As a result, we can be sure that taxation not only makes consumers consume less, but also this lower level of consumption happens at higher prices. And meanwhile, what happens with the money that firms receive as a result of taxation? Let's see. That's an interesting question as well. What happens with the money that firms receive? Notice that the firms don't pocket P1, right? They receive P1 from the consumers, but are obliged to pay a certain share back to the government. So, as a result, they receive only P0. Why P0? Well, P1 represents the new price, and the difference between P1 and P0 is the amount of the tax. It is the increase in the old supply curve due to taxation. So, what the firms get is located back on their original supply curve, while what the consumers pay is located on the new supply curve. Notice also that in addition to changing the prices and quantities on this market, taxation produces a third and a very important event. It has a number of distributional consequences. In other words, it takes rents away from someone and gives it to someone else. We'll discuss these distributional consequences of taxation during the live lecture. But before we even go there, let's think about how much consumers pay now, how much firms get, and who pockets the difference. By the way, lump sum taxation has a very similar impact on equilibrium, and that's why we don't discuss it here. Okay, so it's time to sum it up for the week.